A new year always brings a host of market predictions from the pundits, but our guest today says investors should be focused on what's happening in the here and now. Joining us now to discuss, Ben Gossack, Managing Director and Portfolio Manager with TD Asset Management. Ben, always great to have you on the show.
Yes, love to be here live talking to you, and looking forward to chat markets and trends.
Markets and trends, of course. I know you're a big believer that when the calendar flips over, we've done another trip around the sun. I'm being obviously facetious here. Everything changes and we need to change everything too. That is not the way you view the world.
No, that tends to be the general belief. New year, new trend. But I do find that in many cases, what is happening will just be a continuation of an existing trend. It just so happened, I would say, maybe at the end of 2022, we saw a lot of the large cap mega stocks make their bottoms in December. And so when they started their rally, it made it look like they were, let's say, up 70%. You know, it seems like a really big return. But that, to me, was more of a coincidence.
Okay, so let's talk a bit about that, about the fact that when people take a look at the 2 years behind us, so 2 years of gains for the S&P 500, big gains. Can we go into a third? People start to look at the historical record. You try to shy away from that too in terms of the past being able to tell us what the future is going to look like.
Yeah, I mean, there's enough people out there providing that content, and especially as you said, as we round the sun, I do find everyone wants to be a time traveler. Either tell us what markets, is this market like something back in the 70s or 80s or 90s? And it might be similar, but I think the market is different. And then as much as we know that the experts can't predict the future, we kind of like to get the what's the gist, what's the themes that are happening. And I can assure you, if there's been a preview sent to my inbox, I've deleted it.
Okay, so we know where you stand. Let's talk about what you're looking at in the here and now, as we said off the top. The U.S. dollar, and this isn't a 2025 story, the U.S. currency has been on the move against that basket as represented by the Dixie that so many people look at for quite a couple months now. What is going on?
Yeah, so as much as people, again, focus being on time travelers, I'm doing my very best to stay in the present. I think it's hard enough just to figure out what's going on. We've had, since for most of, I'd say, starting sort of mid of last year in 2024, we've seen a bid in the dollar. What people are looking at here would be the DXY index. Some people call it the Dixie index, but it's the US dollar versus a basket of currencies. And if any Canadians have been traveling recently, you have experienced a very weak Canadian dollar versus the US dollar. But it's not just a Canadian thing, it's euros, it's yens, it's all over the board. This typically has been a headwind to markets. If we just look at a corporation, if I look at my accounts and I look at my debts, I'm like, ooh, I can manage that, I can budget for that. All of a sudden, the dollar gets stronger and my currency gets weaker. Well, now my debts got bigger. Then I got to think, can I raise prices? Will volumes increase? Like, how do I make up that difference? And that's what creates strain. And if you're located in the US and you have business overseas, well, a strong dollar means the gains that you made in Japan, in Europe, in Australia, they translate to less profits, less free cash flow. So it generally puts a strain on the entire system. Having said that, we're only 3.5% off the high. So we have had a market that's been able to make highs against this. But if this trend continues, I do think we're 3 years into this bull market. That does, I'd say that is a headwind that I would love for it to change going into this new year.
All right, so that U.S. dollar strength, perhaps something that could get in the way of another year of market rallies. Let's talk about what has been working. You watched the trends. Things didn't change overnight on January 1st. What has been working?
Yeah, so we'll look at lots of different charts. We were just at new market highs for the S&P. Didn't get sort of a Santa Claus rally at the end of the year, having two back-to-back good years. Lots of talk about tariffs, the dollar. All of a sudden, people will get all worried, even though, like I said, we're only 3% off the highs. So it's helpful to go back to charts that tell you about what's going on now. Where is the strength? Where is the weakness? In this case, we're looking at a sort of risk-on, risk-off chart that I really do like. It's equal weight consumer discretionary in the United States versus equal weight consumer staples. And I look at this as sort of the wants versus the needs. You always have to take care of your needs. That's going to be your toothpaste, your groceries, your toilet paper. We like our wants. People may characterize this as a weak holiday season, but what this is telling you is that consumer discretionary is outperforming consumer staples. The market is in a risk-on behavior. Different ways I could show this chart, but this one, and like to our point in the beginning, it didn't start on January 1st. This is a trend that has started since the beginning of this bull market, and we'll call it circa summer 2022.
I'm hearing a lot of talk about potential in financials. Is this people catching up to something that's already been happening?
So people did take notice to financials, particularly after the election results where Trump took over, and there's all this talk about the deregulation that we saw back in 2016 into 2017. Again, I've actually looked at, so this is a refresh of the chart that I would have shown in October when I was last here. This is a trend that started back in, we'll call it summer of last year. We've had to do this on an equal weight basis, just because when you do US financials on a market cap basis, JP Morgan tends to dominate. What I do want to say though is when I say financials, I think people think about banks first. Banks have been okay, but financials in general have been exceptional. So this could be discount brokerages, so where you buy and sell your stocks and securities. The private equity companies have done very well, particularly private credit. Insurance companies, this continues to be an inflationary environment. They've been able to raise premiums, which means they've been able to raise dividends and buybacks. That's been exceptional. So there's a whole host of companies, asset managers, you name it, that have done exceptionally in the US, and also, we'll talk about the rest of the world. It's all over the place. I'd say that's also a healthy sign of a bull market when you have the financials, which are supposed to be a proxy for economies that are doing well. Like this bodes well for a continuation of this bull market.
Now, if I went out in the street, and as a journalist, you hate doing streeters, right? Just like standing out in the cold, and I asked someone, even on base here, what do you think the big winners were for the stock market in 2025? They said, of course, it was the Mag 7. They lead everything, don't they? Or do they?
Yeah, and this is, again, you're just riling me up.
Winding up Ben Gossack to start the year.
Yeah, so look, the way that we construct indices, the biggest companies matter the most, and they obscure what else is going on. People might look to Shopify or other companies, let's say in Canada, and say, oh, they must have done well. But what we're looking at here, and this is, to me, this is the chart that I'm going to be showing to many people. So we've had two back-to-back years, S&P up, let's say 26%, 25%. Most people will say, well, that must only be due to the Mag 7 stocks or AI-type stocks. What you're looking at here is the S&P 500 technology sector. This could be represented by the XLK ETF if somebody wants to do that at home. We've divided that price by the S&P 500. This is market cap driven. What you're looking at here and what that red line represents is that the technology sector either added no value or detracted any value from the growth of that 25% last year.
Wow.
So effectively, you got no alpha from the technology sector. If it's been flat from an outperformance, underperformance perspective relative to the S&P 500. And when I look at a chart like that, to me, it tells me that it's based itself. So that would mean, okay, maybe they were overvalued and they've grown into their valuation. Again, however you want to frame it, but it does tell me that technology was not a factor in the outperformance as a whole in terms of last year and setting itself up for another leg of outperformance.